Hey, welcome back to Canada Accounting Insights. Today we're diving into a tax topic that pretty much affects everyone. What happens when you sell your personal property? And I'm not just talking about stocks. I'm talking about the unique rules for your home, your collectibles, your everyday stuff. And getting these rules right can save you a whole lot of money. So think about it for a second. Let's say you sell the house you've lived in for a decade and make a nice profit. Is that all tax-free? What about that vintage record collection you sold online, or the patio furniture you finally got rid of? Believe it or not, the tax rules for each of those are totally different. And that's exactly what we're going to break down today. We're basically going on a little tour of your assets. We're going to start with the biggest one for most people, your home. And we'll look at this amazing tax shield that's made just for it. Then we'll get into the everyday stuff you own, and we'll finish up with those special treasures you might have tucked away. All right, let's kick things off with what is probably the single most important tax rule for any homeowner. It's called the Principal Residence Exemption. This thing is an absolute game changer. Why? Because it can literally wipe out the entire capital gains tax bill when you sell your home. And it's not just for a regular house. This can apply to your condo, your cottage, even a mobile home, as long as you or your family lived in it at some point during the year. It's incredibly powerful. Okay, now here's the formula that makes the magic happen. I know it looks a little bit intense, but don't worry, we're going to walk through it with a super clear example. All you really need to know are the key ingredients: the total profit you made, how long you own the place, and for how many of those years you're calling it your main home. And see that little +1 in there? That's actually a bonus year the government gives you to help out when you sell one home and buy another in the same year. Pretty handy. So let's see Daniel and Clara example. They had a house for 14 years and a cabin for 7, and in the same year, they decided to sell both. They made a nice gain of 95 grand on the house and 80 grand on the cabin. But here's the catch. A family can only designate one property as their principal residence for any single year. So they have a choice to make. How do they do it? So how do you find the absolute best strategy? You might automatically think, oh, just shield the biggest total gain. But that's not it. The real secret is to shield the property with the biggest gain per year. When we crunch the numbers, their house gained about $6,785 a year on average. But the cabin that gained over $11,000 a year, it was actually the faster growing asset. And that right there, that's the golden rule to get the most bang for your buck from this exemption. You always use it on your most rapidly appreciating property. So for all those years that Daniel and Clara own both, they should absolutely prioritize designating the cabin to protect that bigger annual gain from taxes. And look at how this plays out perfectly. By designating the cabin for 7 of the 7 years they owned it, they completely eliminate that $80,000 gain. It's gone. Then they can use the leftover years on the house, which still shields $48,000 of its gain. Just by being strategic, they've seriously minimized their tax bill. Now, this exemption is fantastic, and there's always a but, there's a really important new rule you have to know about. It's specifically designed to clamp down on property flipping 12 months. That's the number you have to burn into your memory. It's for the new residential property flipping rule. Here's how it works. If you buy a home and sell it in less than a year, any profit you make is generally considered 100% taxable business income. It's not a capital gain. And that means you can't use that amazing principal residence exemption to shelter any of it. Now, of course, the government knows that life happens. You don't always plan to sell a house that quickly, so there are some really important exceptions to this flipping rule. If you have to sell in under a year because of a major life event like a death, a divorce, a job relocation, or a serious illness, the rule probably won't apply, and your profit could still be treated as a regular capital gain. So that's the house covered. But what about everything inside it? Your personal belongings, your furniture, your electronics, all that stuff. Well, they have their own completely unique set of tax rules. This category is officially called Personal Use Property, or POP for short. And it's exactly what it sounds like. It's the things you own for your own personal enjoyment, not as an investment to make money. We're talking about a huge range of things here. Your car, your couch, your TV, your boat. You get the idea. So, the most important concept for all your stuff is something called the $1,000 rule. It's pretty simple. For tax purposes, the government just assumes that both the cost and the sale price of an item are at least $1,000, no matter what you actually paid or sold it for. What this does is it keeps all those small, insignificant sales off your tax return. So if you buy a chair for $500 and sell it later for $800, there's no taxable gain to worry about. Let's look at this with Sophia example. That camera she bought and sold it for $1,000. So thanks to the rule, the gain is zero. Easy. The comic book, though, she sold for more than $1,000, which created a real $300 capital gain, and half of that is taxable. But now look at the patio set. She lost $2,700 on it. But, and this is key, for personal use property, that loss is denied. You can't use it to offset any other gains. It just disappears. And that brings us to a really critical difference in the tax world. The rules actually separate your everyday stuff, your pup, from your valuables. These valuables fall into a special category called listed personal property, or LPP. Think art, jewelry, rare coins, stamps. Now, gains on both types of property are taxable, but the absolute game changer is how losses are treated. So unlike with your regular stuff, you can deduct losses on your valuables. But, and it's a big but, there are very specific strings attached. You can only use a loss from selling, say, a painting, to cancel out a gain you made from selling another valuable, like a rare stamp collection. You can't use that loss to lower your income from your job or from stock market gains. But you can carry those losses back 3 years or forward 7 years to find other LPP gains to use them against. Okay, let's pull this all together for a quick recap because we've covered 3 totally distinct categories. First, your principal residence, where the gain is usually exempt. Second, your personal use property, your stuff, where gains are taxable but losses are denied. And finally, your listed personal property, your valuables, where gains are taxable but your losses are deductible, just only against other LPP gains, you know. Understanding these differences isn't just some boring tax exercise. It has real-world financial consequences. Applying that principal residence exemption the right way, or just categorizing a sale properly, can literally save you thousands of dollars. So the question I want to leave you with is this: are you tracking your assets with these tax rules in mind? Thanks for watching. If you found this video helpful, don't forget to hit the button like and subscribe. See you in the next video.